Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Kieran Kerwin, Senior Investment Strategist at ProShares. We're talking about dividend growth ETFs today. Kieran, welcome back on the program.
Hello, Nina. Great to be with you today.
So I wanted to start with the current market environment. Markets have been on a wild ride of late with trade tensions and global growth slowdown and also rising geopolitical uncertainties. An inversion of the yield curve has led to recession fears now, and as a result, investors have been piling into safe haven assets like government bonds and gold. So tell us what you think of the current market environment.
Right. It certainly has been an interesting ride of late, Nina, and I think you're right. The market is fundamentally struggling with the word low, right, and the idea of low rates and low growth. And it's certainly not been easy to be an investor, and sentiment has certainly turned negative over the last couple of weeks. But I think if you look at a few kind of things about the market, it maybe puts it into better perspective. For example, valuations. Right now, if you were to look at, for example, the forward PE on the S&P right now is somewhere around 16 or 17 times. Mm-hmm. And people would say, wow, that's above both the 5-year and the 10-year averages. The market looks very expensive. But we really advise all of our clients to put the market into context relative to where rates are. And historically, if you look at where valuations have been in periods when we've seen such low rates, we can make a reasonable argument that valuations are really more in line with where they should be, given that those future cash flows are worth more, all else being equal. And of course, if you were to look at, say, equities versus bonds on a yield basis, right, stocks look great, right, relative to those bonds. You've got the S&P 500 yielding more than the 10-year and somewhere right around what a 30-year domestic bond or U.S. bond would pay you right now. So it's all a matter of perspective. Certainly the bouts of volatility have been hard to stomach. Market's been episodic of late. Looking at the dispersion of returns, say, between 2017 and 2018, and even more recently, think about where returns and market sentiment was in Q4 of last year relative to Q1 of this year. It's certainly, as I mentioned, been a tough market to navigate.
Yes, I agree with you. It's been a tough market, but I also agree that valuations look reasonable and growth has been good in the U.S. so far, and particularly relative to bonds, equity valuations look quite reasonable. And as you mentioned, the S&P 500's dividend yield is actually, it exceeded 30-year Treasury bonds yield yesterday because investors have been buying bonds, piling into bonds. So bonds actually look quite expensive now. So for long-term focused income-seeking investors, it really makes sense to look at dividend-paying stocks. And dividend-paying stocks, they tend to usually hold up well during volatile markets because these are companies with strong balance sheets and strong, steady cash flows. And when we talk about dividend-paying stocks, there are two popular dividend investing strategies, growth and yield. So can you talk about the investment case for dividend-paying stocks in the current market environment, and particularly why investors should consider dividend growth strategies and not high dividend strategies?
Yeah, it's an interesting question and certainly relevant for this market, Nina. I think the case for dividend stocks, in our view, is kind of an evergreen one. Certainly, dividends have always been important to total returns, right? Historically, if you go back to 1960 and you look at the component or how much dividends have contributed to the stock market's total return, it's been significant. Something like 33% of the market's total return over time has come from stocks paying a dividend. Now, certainly there's some seasonality or cyclicality to that. Look at the 1970s, for example. Dividends accounted for almost 3/4 of the market's total return. In the 90s, by contrast, dividends only accounted for something like 16% of the market's total return. So there is variability there, but we would argue that dividends are always important and never go out of style. And today is really no different. And we could make a pretty good argument, as a matter of fact, for dividends, the percentage of dividends relative to total returns in the near term may be higher, right, than that 33% number. And, that all kind of comes from when you look at the components of equity returns over time. You start with a dividend yield, you take an earnings growth component, and you look at how valuations may change. Those are really the building blocks, if you will, of total returns over time. And, we talked about valuations being fairly valued. Stocks are fairly valued there. We didn't talk too much about earnings growth, but we've just seen Q2 earnings growth come to an end, and the market basically was flat on a year-over-year basis. So there aren't any earnings growth looking at it that way. So therefore, we believe that dividends will be, in fact, an important component for total returns over the near term. And that's one part of the story. The second part of the story, as you pointed out, there's a pretty big difference between the dividend space in total. And we kind of think about it along two fundamental components. You do have strategies that focus on the high-yielding stocks, right? And you do have strategies, by contrast, that look for growth of the dividend. And those two things are very different creatures. They're very different animals. This year, as a matter of fact, we've seen quite a return dispersion between the two strategies. It turns out what's doing well in the market is not necessarily the high yielders, but it's more those companies that grow their dividends over time. And we do think that has something to do with quality and where we are in the cycle, right? The companies that manage to grow their dividends over time tend to have higher quality balance sheets, tend to have less leverage. They tend to hold up better in periods where we see higher than usual market volatility. And the lower quality stocks, those tend to be the higher dividend yielders. They tend not to hold up quite as well, and that's what we've been seeing so far this year.
Okay, so could you talk a little bit about how these dividend growth strategies have performed during the recent market sell-off? Did they hold up better than the broader market?
Sure, and we like to look at performance a couple of different ways to assess that. One of the things we like to look at, for example, is upside and downside capture ratios, right? So when the market is trending down, as it did in Q4 of 2018, we see that consistent with historical times, high-quality dividend growth stocks held up much better than the overall market. So, for example, if you look at the S&P 500 during that fourth quarter of 2018, it was down roughly 14%. But if you focused on a group of high-quality dividend growth stocks, for example, like the S&P 500 Dividend Aristocrats, that group of stocks held up much better and fell only about 8.5%. And that's generally true across large cap, mid cap, and small cap stocks. You have a similar kind of pattern. Higher quality dividend growth stocks in general hold up better when the markets get choppy. On the flip side, right, if you look at the upside capture, these are strategies that tend to give you most of the market's upside. So don't expect them to kind of tear the cover off the ball, if you will. But generally speaking, an 80 to 85 to 90% upside capture is typically what we see with high quality dividend growth strategies, and that's generally what we've seen in 2019 thus far.
Okay, very interesting. So let's take a look at your dividend growth suite. You have 6 ETFs, 3 US focused ETFs, and 3 international ETFs. So let's talk about the US equity ETFs first. These are S&P 500 Dividend Aristocrats ETF, ticker symbol NOBL. Then S&P Midcap 400 Dividend Aristocrats ETF, ticker REGL, REGL. And this one focused on smaller stocks to small cap stocks. It's the Russell 2000 Dividend Growers ETF, ticker symbol SMDV. Now, in full disclosure, I hold SMDV in an ETF portfolio that I manage for our clients. So tell us more about your dividend growth US equity ETF suite.
Yeah, so at ProShares, Nina, we do consider ourselves to be leaders in the dividend growth space. As you mentioned, we have a full suite of 6 products across both large cap, small cap, and mid cap in the U.S., and then 3 international strategies. Really, I think 2 things stand out and make ProShares' suite of dividend growth products unique in the marketplace. First of all, we focus on companies with the longest year-over-year track records of dividend growth. So, for example, with our flagship fund, as you mentioned, NOBL, that tracks the S&P 500 Dividend Aristocrats Index. For a company to be a dividend aristocrat, it needs to have grown, so not just paid, but grown its dividend for a minimum of 25 consecutive years. There are 57 of those names currently, and on average, those 57 names have grown their dividends for a minimum of 40, or an average of 40 consecutive years. When you think about that, that's a remarkable feat to achieve, right?
Yeah,
if a company can simply pay a dividend over periods of economic expansion, contractions, wars, recessions, the impact of technology, that fundamentally changes the way businesses are functioning. It's a very, very impressive achievement to be able to grow a dividend each and every year over those periods. So that's one thing. And then we equally weight all of the names of our portfolios. So once we identify those stocks that meet our criteria, each and every stock has an equal opportunity to contribute to performance within the context of the portfolio, and that is a unique facet there. And then the second thing I would say, which is unique to ProShares, is that we do have the largest lineup of dividend growth strategies. So many fans of dividend and dividend growth strategies, for that matter, only look to apply that in large caps, right? Investors associate dividends with the large cap space, but really, we would tell you that a dividend growth strategy in the domestic mid-cap area and in the domestic small-cap area, for example, are equally effective and give you the same characteristics that we look for in large caps. We just vary the number of years that we require for dividend growth. In order to build a fully diversified portfolio, we demand that companies in our mid-cap strategy, REGL, to have grown their dividends for a minimum of 15 consecutive years. And in our small cap strategy, SMDV, we require small cap companies to grow their dividends for a minimum of 10 consecutive years. But regardless of the strategy, what you're going to wind up with is a group of high-quality stocks with very strong balance sheets, good fundamentals, the ability to continue to deliver earnings growth in very difficult periods. And over time, we believe that those stocks, based on their historical records, will continue to outperform the market with lower levels of volatility.
Yes, not many small cap companies pay dividends. So I'm surprised that there is a portfolio of companies that have not only been paying dividends, small companies that have been paying dividends, but they have actually been increasing dividends continuously for last 10 years. That is why I decided to include SMDV in the ETF investor portfolio. So these are excellent products, and these are all focused on high quality companies which have been continuously increasing their dividends. And these are focused on US stocks that continue to outperform international stocks. And international stocks, emerging market stocks in particular, have been beaten down this year due to trade tensions and a stronger dollar. But many investors are now concerned about stretched valuation in the U.S., though we discussed that if you look at reasonable relative valuations, equity valuations in the U.S. don't look unreasonable. But for investors who are worried about valuation in the U.S. and they are looking for bargain opportunities in international markets, I think it makes sense to look at some of the international dividend payers. And you have 3 ETFs, as we briefly mentioned earlier. So could you tell us about those 3 ETFs?
That's right. Good observation there, Nina. And to close out our suite, we do have, as I mentioned, 3 international dividend growth products. The first of which goes by the ticker of EFAD, so EFAD. And what that strategy does is follow international developed markets. So those companies within the MSCI EFA index, which have grown their dividends for a minimum of 10 consecutive years. We also have a European-only version of that. And then, as you mentioned, EMDV, so Emerging Markets Dividend Growth product, rounds out our suite. And that's another product that maybe strikes some folks initially as being very unique, right? We don't think about dividend paying and dividend growing stocks in emerging markets, but in fact the results that we've seen there have been equally as impressive. So all of our strategies essentially do the same thing. And as you mentioned, now may be the time for those investors who are maybe looking at the U.S. market as being late in the cycle. Perhaps they may not like those valuations as much. Perhaps they're looking for a little bit more yield. Going into international markets may prove to be a wise decision, and doing it in a high-quality manner through a dividend growth strategy, in our view, makes a lot of sense, especially in this type of market.
Okay, so switching gears a little bit, tell us how investors have been using these strategies in their portfolios. Your flagship product, NOBL, is actually quite popular with investors. So what kind of use you have seen as a core product in the portfolio, or other strategies that you have seen?
So you're right, Nina. Most of our investors would kind of look at our suite of dividend growth products as being core components of their equity portfolios. They really have a nice blend of both growth and value stocks, if you will. Oftentimes, investors see the word dividend and they only view, or they equate the word dividend with value. It's not necessarily the case, right? Because we are looking for companies that grow their dividends over time. The only way you can do that is to grow your revenues, your cash flows, and your earnings, and then return those to shareholders. So there's certainly a growth component to our portfolios. All of them are core, as you mentioned. Most of our clients in our strategies today tend to be one of three types. Either they have moved away from active strategies, and we all know that active strategies have continued to struggle to beat their benchmarks over long periods of time, and a rules-based ETF, right, at a more reasonable price point with some tax advantages and very good performance have certainly been appealing to those types of investors. And then you've got other folks who perhaps want to move away from simple market cap weighted passive strategies, right? Those certainly have been gathering a lot of the investor attention in ETF land of late. But we think if you move out the spectrum a little bit into a rules-based strategy, in our case focusing on only companies that continue to grow their dividends, we may be able to get you a little nicer risk and return profile for your portfolios. And then the third kind of grouping of investors who are using our products, maybe looking to either move away from or complement higher dividend yielding strategies. We all know that the dividend yield right now is very critical, right, for investors who may not be generating the income that they need from their fixed income portfolios because rates have been so low. So utilizing a dividend growth product can be a nice complement to their income needs, and maybe do it with a smoother ride in a more consistent manner than the high dividend yielders, which, as we mentioned previously, tend to be a little bit lower in quality and therefore might make the most sense in an up and down market like we've seen.
That makes sense. And with all the uncertainties, I think market will continue to be volatile. So it does make sense to invest in these high quality companies that have been paying and increasing their dividends for many, many years. So that's all we have time for today. Kieran, thanks again for joining us.
Thank you, Nina. Always great to be with you.
Thanks for listening. If you want to learn more about these ETFs, please visit brochures.com. Make sure to be on the lookout for the next edition of ETF Spotlight, and also make sure to subscribe. If you have any comments or questions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute, an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.